Hello, welcome to the course Corporate Finance. This is the third module. And last module, we were able to look into financial analysis and planning. And under that, we looked into financial statement and ratio analysis. We'll be looking at the second part of the financial analysis and planning today. And with that, we will be discussing on the cash flow forecasting and budgeting, and we also look into time value of money concepts under the financial planning as such. And financial planning is a process of forecasting future cash flow, developing budgets, and also aligning resources allocation with organizational objective. And it ensures company can meet their financial obligations, capitalize on investment opportunities, and also withstand market uncertainties. When we talk about effective planning, it actually ensures that companies can meet their obligation, seize investment opportunity, and withstand uncertainty. And the techniques um, the techniques such as cash flow forecasting and budgeting helps managers to be able to anticipate um, funding gaps, avoid liquidity crisis, and also allocate capital efficiently. And underpinning both financial analysis and planning is the concept of the um, time value of money, which recognizes that a dollar today is worth more than a dollar in the future. And the TVM, the time value of money, provides um, the analytical basis for evaluating investment projects, comparing financing alternative, and also determining the present and future value of cash flow. And by mastering these two core elements, corporate managers will have the ability to be able to gain, to be able to diagnose financial performance, plan strategically for growth, and make decisions that balance profitability with sustainability. We will look into it one after the other. Um, Looking at cash flow forecasting, it's actually a critical tool for predicting a company's future cash inflow and outflow over a specific period. So it helps to be able to actually forecast. It helps to be able to look into and predict what the cash flow, inflow, and outflow will actually be for over a period of time. And the goal is to ensure that the firm has sufficient liquidity to meet its short-term obligations and plan for future needs. Also, this process helps business identify potential cash surpluses or deficits in advance. We will look into budgeting as a very, very important aspect of when we talk about cash flow forecasting. Financial planning rather. A budget is a quantitative plan for allocating resources to specific activities over a given period. A budget is a quantitative plan. Note that it's a quantitative plan for allocating resources to specific activities over a given period. And the key objective of budgeting is actually to provide a framework for planning and controlling resources, to coordinate activities across different departments, and to establish a benchmark for performance evaluation. We'll still look into that one after the other. And types of budget, we have the operating budget, which focus on revenue and expenses. We have the cash budget, which deals with detailed cash inflow and outflow. It actually provides information about cash inflow and outflow. We have the capital budget, which gives a plan for long-term investment. We have the zero-based budgeting, which requires managers to justify all expenses from a zero-based angle or point. Now, when we talk about time value of money, let's look at it as a concept. At its core, the time value of money recognizes that a dollar today is worth more than a dollar in the future due to its potential earning capacity, and it provides an analytical foundation for evaluating investment projects, also comparing financing alternative, and also determining the value of cash flow over time. And the component of time value of money had in present value, future value, and the annuity, discounting and compounding, and also the perpetuity. And we will look at that one after the other. Talking about the present value, it's actually the current value of a future sum of money or a series of future cash flow. The present or the current value of a future sum of money or a series of future cash flow. And it answers the question, how much must I invest today to be able to receive specific amounts in the future? And we have the formula there. That's present value is equal to future value uh, divided by 1 plus r raised to power n. And f is future value, r is the interest rate, and the n is number of periods. For the future value is the value of a current asset at a future date based on an assumed growth or interest rate. It's the value of a current asset at the future date based on the an assumed growth or interest rate, and it answers the question, what will my investment today be worth in the future? If I actually invest, what will my investment be? So the formula to calculate the future value is the present value multiplied by open bracket 1 plus r close bracket raised to power n, and the PV is the present value, the r is the interest rate, and the number, n is the number of periods. Looking at annuity as a component of time value of money, it's a series of equal payments made at fixed interval. And the TVM concept can be applied to find the present or future value of an annuity. And for perpetuity, it's a special type of annuity that involves an infinite series of equal payments. Yeah, and it is often used to value assets that provides a constant stream of income, definitely. And lastly, compounding. This is the process by which an assets earning from either capital gain or interest are reinvested to generate additional earning over time. In conclusion, financial planning, forecasting, and budgeting are essential for guiding a company's financial health and strategic direction. And the time value of money provides the fundamental framework for making rational financial decisions. So together, these tools enables managers to navigate uncertainty, allocate resources efficiently, and ultimately drive sustainable growth and profitability. Thank you.